Skyl, very nice to have you with us. Let's start by talking about some of the data we've had out of the UK today. We've had the inflation print, which has not come in as hot as had been feared, and traders are adding to Bank of England easing bets as a result. Is the sense here that if inflation isn't quite as much of a problem as we thought it was, there are fewer barriers to easing for the BOE?
Yeah, I mean, I think that's absolutely it, because you have a weakening labor market, growth isn't as strong, and so inflation, what's really holding you back. And I think what's actually super interesting about the inflation data this morning is that it was to be expected you'd get a downside surprise. It's this emerging seasonal trend that we've seen where, because you have these big price resets in April, so stuff like your phone bill rises by RPI, it's the start of the fiscal year in the UK, so you have increases in taxes, et cetera, that come through at that point, as well as a price energy cap increase. You get this distortion in the data, and it wasn't an issue before COVID because inflation was low, but now when you have higher inflation, it's adding to that persistence. And so you see this trend where activity as well as inflation surprises to the upside in the first half of the year in the UK, and then into the end of the year in the fourth quarter, it surprises to the downside. So you can expect that to continue, and it likely means that a Bank of England cut this year is very much in play, and that should be the benefit of gilts, especially at the front end.
Okay. We're getting some data out of the UK. We're not getting any data or much out of the United States. The data we have is distorted by a number of different factors. Are we flying blind here? How can we get a handle on what is really happening?
Yeah, I mean, there are data points here and there that we can look at, and so that's why last week we had such a big focus on bank earnings, because that tells you about the consumer and businesses. But it's something that I'm very much worried about with regards to the U.S. in terms of giving a false signal to the Fed. So we've had the reference week now for the October employment report that happened during the shutdown. And so it's likely to be artificially weak. And the worry is that the Fed reads that it's one of two employment reports we get before the December meeting, which I think is more in play than the October meeting. And we don't know if we'll get the November report in time in terms of will it happen when the shutdown is occurring still or will it not. And so it could make the economy look artificially weak, force the Fed to overease, and then you might have an overheating economy into 2026.
Are those the jitters that are fueling the gold drop? I mean, we're trying to do a little bit of detective work here in terms of what is actually, could they be kind of underpinning that move? What do you think it is?
Yeah, I mean, I think it's just kind of a frothy market, right? You've had such a large move in such a short period of time. If you think about it as a reallocation away from dollar reserves or anything else, the market sizes are very different, right? The US dollar market is much larger than the gold market, which is larger than the silver market. And so as you get these kind of jitters and you're just saying, oh, it's a really frothy, elevated level, you don't necessarily need a big news or anything to have that feed out in quite an aggressive way. What I will say is, in the long term, I think you're still likely to get more gold upside from here. It's a structural shift, right? You're having central banks that are realizing that they need to have reserves that are comparable to the average across market. So China, for example, it's at something like 5 or 6% of reserves in gold, and they need to get up to 20%. So that's going to be a bid that continues, especially if we are worried about kind of the risks that are ongoing, like politics, et cetera.